Do you know why your strategy is making money? Better yet, can you do so in one sentence? If not, then you are most likely to fail in your trading, and I'm sure you will find this video very helpful. Before we start, be sure to subscribe to our YouTube channel to be notified of my next videos and to subscribe to TIOmarkets.com/analysis to receive my industry-leading market analysis reports by email. Do you know what a trading edge means? In very simple terms, it means that over the long run, your trading is likely to produce more winnings than losses. Okay, that makes sense, you might say. But how big of an edge one should have in order to make serious winnings? Let's look at an example from the world of gambling and casinos. In American roulette, the house edge is 5.3%, while in European roulette, the edge is only 2.7%. This, however, doesn't stop the casinos making millions. Therefore, as a trader, you shouldn't aim for an unrealistic 90% success rate, but rather just make sure you are correct about 50% of the time, and with each winning trade, make more than you risk. This means that after the next 10,000 trades, your account has grown by X% and you are a successful trader. In this video, we will focus on how to use support and resistance levels in creating such a trading edge. Defining support and resistance levels. Support is a price point or an area at which the price has been unable to move any lower and has bounced higher. As a result, this level is afterwards regarded as a technical support level. Also, price levels or areas that have in the past resisted price moves but have been since penetrated could act as supports. Resistance is a price point or an area at which the price advances have failed to move any higher. This has resulted in prices dropping lower. And again, the supports that have been broken are now likely to be levels or areas that act as resistances. Drawing support and resistance levels. Traders draw support and resistance levels at the very edges of the price moves, also known as swing points. This makes sense as the price levels that move the market significantly clearly are important. Price action around the support and resistance levels. Quite often though, the markets penetrate the support and resistance levels slightly and then reverse the earlier price move. In this example, EUR/USD moves 9 pips below the support level before bouncing higher and rallying strongly. On some other occasions, the market approaches a support level but starts to rally from the proximity of the level without touching it. Here, EUR/USD traded lower intraday, but then the buying started 16 pips above the support level. And the same applies to resistance levels too. In this example, EUR/USD penetrates the resistance by 23 pips before dropping 430 pips. Support and resistance areas. Therefore, we need to treat the supports and resistances not as levels but rather as areas. This basically means that in order to have an edge, our trading method needs to be tailored to fit such a market behavior. Entering into a position. Here are two alternative approaches you can employ. You can, for instance, start using wider stops and smaller position sizes. This method keeps your risk under control even if the stops are further away from your entries. Alternatively, you can scale into your positions. This approach allows you to read the price action and gather more information while building up your position. Do you want to learn more? If you want to learn more about these methods, join me to our free and interactive webinars at TIOmarkets.com/webinars. What about the timeframes? How reliable are support and resistance levels in smaller timeframe charts? As a rule, with smaller timeframe intraday charts, a trader can find more trading signals, but these signals fail more often. The higher the time frame, the higher the reliability of any technical signal, and this applies to support and resistance levels also. Higher time frame charts are easier to trade. Higher time frame price levels are not only more reliable, but also likely to move the price further. They are also easier to identify. For these reasons, new traders should focus on trading off higher time frame support and resistance levels. Identifying a support level is relatively easy. We look for swing points from which the market 1 has turned higher after retracing to it, and 2 has rallied strongly higher. If the level has not been penetrated after the identified swing point, the level is a valid support. We look to trade long from the proximity of such levels until they are decisively penetrated. Identifying resistance levels. Identifying resistance levels is likewise fairly simple. Now we look for swing points from which the market 1 has turned lower after rallying to it, and 2 has then dropped significantly lower. If a level like this hasn't been penetrated, it is a relevant resistance level, and we look to trade short against it. Thank you for your time. Be sure to subscribe to our YouTube channel to be notified of my next videos, and to subscribe to TIOmarkets.com/analysis to receive my industry-leading market analysis reports by email.